The financial crisis of 2008 was one of the worst economic crises in modern history, comparable in severity to the Great Depression of 1929. It originated in the United States, but its consequences quickly spread throughout the world, causing bank failures, economic recession, and severe hardship for millions of people. To understand how we got to this point, it is necessary to analyze the root causes of the crisis, the collapse of the banks, the measures taken to address it, and the long-term consequences. In the years before the crisis, the U.S. economy was characterized by a strong expansion of the housing market. Banks and financial institutions, thanks to favorable monetary policies and regulation of the sector, began to grant increasingly risky mortgages to people with poor credit ratings, not like subprime mortgages. These loans were offered with interest rates that were initially very low, which then increased over time, making it difficult for many borrowers to continue to make payments. The logic behind these loans was that home prices would continue to rise, allowing homeowners to refinance their debt or resell the properties at a profit. Banks, however, did not just make these loans. They began to package them into complex financial instruments, such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. These financial products were sold to other banks and investors around the world, spreading risk globally. To make matters worse, rating agencies such as Moody's and Standard & Poor's gave these financial instruments overly optimistic ratings, often classifying them as safe investments, even though they were based on highly risky loans. In 2007, the housing bubble began to burst. Home prices stopped rising and began falling, leaving many homeowners with mortgages that were more than their homes were worth. Unable to sell or refinance, millions of Americans began to default on their mortgages. This led to a ripple effect. Banks that held subprime mortgage-related securities began to suffer huge losses, and confidence in the financial system began to falter. Panic quickly spread as investors realized that many financial institutions were holding huge amounts of these junk bonds. In September 2008, the situation reached breaking point with the bankruptcy of the investment bank Lehman Brothers, one of the largest and most prestigious on Wall Street. The U.S. government decided not to save it, triggering an unprecedented crisis of confidence. The markets collapsed, banks stopped lending money to each other, and the financial system risked complete collapse. To avoid total collapse, the U.S. government intervened with the TARP, Troubled Asset Relief Program, bailout plan, allocating hundreds of billions of dollars to recapitalize the banks and guarantee the liquidity necessary to restart the system. The Federal Reserve also intervened, lowering interest rates to near zero levels and injecting huge amounts of money into the economic system through extraordinary monetary policy measures, such as quantitative easing. In Europe, many governments were forced to intervene to save their banks, but this aggravated public debt and contributed to the sovereign debt crisis that hit countries such as Greece, Italy, Spain, and Portugal hard. The consequences of the crisis were devastating. The global economy entered a deep recession. Millions of people lost their jobs, and many families found themselves in economic difficulty. Companies reduced investment, unemployment rose, and confidence in the financial system was severely undermined. Economic inequality increased, with many people losing their homes to foreclosures, while large banks were bailed out with public funds, fueling strong social resentment. In the years that followed, governments introduced new regulations to try to prevent a similar crisis from happening again. In the United States, the Dodd-Frank Act was passed, imposing tighter restrictions on banks' activities and greater transparency on complex financial products. However, many critics argue that the reforms were not enough and that the financial system remains vulnerable to new crises. Years later, the crisis of 2008 has left a deep mark on the global economy. It demonstrated the risks of deregulation and uncontrolled financial speculation, highlighting the importance of stricter supervision of the banking sector. Although the global economy has recovered in the years since, its scars are still visible, with slower growth, rising inequality, and still fragile confidence in the economic system.